tough call to do to check out what to do with your money now. Sunil Singhania, head of equities at Reliance Mutual Fund, joins in to discuss just that. Good morning, Sunil, and thank you for joining us on what looks like a very big day for the markets. We thought it would pale compared to the rally on Friday, but the market's not looking back. What's your sense now? With incremental cash, should one still go ahead and buy, or are we now entering dizzying terrain?
So actually, as I said, it's a tough call for investors who have still not invested. But Lata, if you see over the last 1 year, so many macroeconomic factors have changed for the positive. Whether it's the current account deficit, whether the rupee being stabilizing, even the inflation numbers. And on the fundamental front, you have seen profits now, at least for the top companies, coming on track to 15-17% growth. We had a news item today that profits have inched up to 16.5%, and that's after 6-7 quarters of, you can say, disappointing operational results. We are seeing profit growth. So I think this event is maybe a catalyst, but on a fundamental front, the markets have really seen good, you can say, improvement both on the macroeconomic front as well as the fundamental front. And from March 13 to March 14, actually markets went up only by 11%, except the last 2-3 days. Okay. So, despite all this fundamental improvement, we have not seen the markets move up significantly. So from our perspective, I think, yes, people who have not invested last 5-6 months, they have missed out. But very clearly, the way the fundamentals are improving, I think there is definitely room for more.
Sunil, hi, good morning. I can see that big smile on your face, but rightfully so. I mean, after so many years of being range-bound, the market has finally broken out. If there is a stronger than expected government formation, then what could be the potential upside to this market?
It's a very difficult call to take. As I said, if you just see the fundamentals, I was mentioning about the profit growth. Markets always mimic the profit growth. So from 2003 to 2008, you had profit growth of 21% plus. Last 5 years, we have seen profit growth of only 7-8%, and that also was skewed towards only 1 or 2 sectors performing. I think we are now entering a range where profit growth of corporate earnings can be more than 18-20%. You're already seeing 15-16% analyst expectations. If you have some cash flows or fund flows come into the country, you have a more stable currency. And on the back of it, if you start to have a benign interest rate environment, then profit growth can be significantly higher than what analysts expected. So I think in 3 years' time, if we have, say, 20% profit growth, you can have corporate profits almost doubling from where they are right now. And I think over a period of time, the economy, the markets will always mimic this. So I think we are quite optimistic that going forward, we are entering a phase where the macroeconomic and the corporate fundamental factors itself should propel equity returns upwards of 15% plus.
Actually, Sunil, you spoke about year-on-year, March 13 to March 2014, the Sensex being just about 10% higher. The indexes, BSE 100 index is 13% higher, but your equity opportunities fund is 18% higher, and you'll have a very good record in terms of individual stock performance as well. And therefore, what is the advice from here on? From now to March 2015, what is your best guess of the index, and what would outperform the index in terms of sectors?
See, frankly, I'm not in the index guessing game, but what I can say is that in the last 5 years, if you see the economy...
Give us qualitative directional
I'll give you the answer in a way where...
We're not going to let you go until you stick your neck out.
See, very clearly, last 5-6 years, we have seen an almost flat market, except the last few months. And the economy has grown from roughly $1.1-1.2 trillion to almost $2 trillion. So we've added a lot of wealth in terms of the gross domestic product. It has not got translated into the markets, because from a phase where we were overvalued, we have entered into a phase where we were undervalued. We can say that now we are almost fairly valued, but this fair valuation is based on very benign expectations. So I think the moment those expectations rise a bit, you might start to see, markets giving a higher P multiple, because the growth rates can therefore be higher. So we are very convinced that, I don't know what March 15 would be, but maybe we are entering a phase where a high growth rate for the country and high growth rate for the corporate earnings is very visible. So our bet would be that, it would be the best asset class among all its peer groups. So I think,
Okay. What is the market factoring in terms of a win for the NDA, the seat tally, and what will disappoint the market on 16?
See, I don't know about NDA, but we are banking on a stronger government. And I think irrespective, we have seen so many changes in the government over the last 15-20 years. And always the markets will expect something and not expect something, but eventually it's the fundamentals which are going to play out. So I think markets are definitely expecting a stronger government, and we also expect that, and we are optimistic that we'll have a stronger government.
Okay, sectoral mix, even if you don't give us the, a guess in terms of the, Sensex value or Nifty value, what would you stay with?
Again, Lata, if you see last 3-4 years, we have seen a skew towards sector allocation, where people wanted to be in safer stocks and safer sectors over anything else, So whether it was a 40p multiple stock,
now
or
the
50p,
rotation has begun.
Yeah, so that's what, So I think the initial move would be towards the other sectors, which would be more domestic cyclicals. But our view is that we cannot ignore even sectors like, say, IT and pharma, because that is where the free cash flow is, that is where the growth is, and also the valuations in the last 3-4 months, specifically on IT, have become much more attractive. So while the initial move may be towards the capital goods and the banking and the other sectors, but I think over the last 3-4 months, the undervaluation or the difference in the valuation between these two sectors have corrected quite significantly.
Would you increase?
Exactly, because they've corrected. How would you go forward? I mean, would you keep, say, pharma at 10% and IT at 10% and cyclicals at 60-70%? How would the mix look like?
Yeah, so from our funds perspective, though the IT allocation has reduced a little bit, we still are slightly overweight. And as far as pharma is concerned, we are significantly overweight, but we are significantly underweight the consumer sector. So I think we are playing the consumer sector through the pharma, because we believe that that is where the growth is higher.
Would you increase your allocation in the banking space? And if yes, which pocket would you look at, PSU versus private?
We have increased our weight slightly, but we are not significantly overweight, because we believe as a fund house that we have to balance the risk also. So, just because it looks good as a sector, you just go and don't buy everything. Our weightage is skewed more towards the private banks, and among the public sector banks, it is mostly in the larger public sector banks. We have increased our weight a little bit on the smaller public sector banks, but that's a more tactical trading call rather than a long-term fundamental view.
Has retail, even shown the first tentative steps of coming back? I mean, no, I don't mean the HNI. I mean fund flows into, say, suspended SIPs being continued in the last 1 month, last 2 months.
So I think in the last 2-3 months, we can't say that the retail has started putting in money, but the redemptions have slowed quite significantly. And the other positive thing is that people are willing to meet us now. They're not even willing to meet us. So I think there is definitely an interest in putting money in, but there's an hesitation because people will feel that, we have already hit the new highs. And normally, new highs is a deterrent till it stabilizes a little bit. So I think once the market stabilizes, once this huge rise or fall sort of, reduces, that is the time when we'll start to see money coming in. But just to give you some numbers, we have like less than 1% of the net wealth of the country now in equities. You can't go any lower, And the alternative asset class, whether it be real estate or gold, are giving you negative returns now. So the retail investors have started to feel the pinch. And on the other hand, you have returns of 20 to 45% in different mutual fund schemes, And I think that is also becoming more and more visible. So it's a matter of time.
So what are the 1 or 2 things that you would like to hear from the new government that will bolster this market rally further?
I think from any government, not a new government, I think the strength in this country is entrepreneurship. And, we have a fabulous pool of entrepreneurs, both existing as well as new. And if we are able to just give them a little bit of encouragement, the GDP can easily be 8-9% without us doing much. The regular stuff which the government needs to do, whether it's on infrastructure or creating the environment of growth, that is all fine. But I think, the push towards entrepreneurship is what this country needs. And I think from our perspective, we'll be very happy with a government which encourages entrepreneurship and, growth in manufacturing as well as services from an entrepreneur or private sector perspective.
If you got more money in your equity opportunities fund, I assume that is an unencumbered fund. People are not asking you to go for growth or value. It's a totally fund manager discretion fund. Would you put more money in mid caps rather than in the heavies?
See, again, in our basket, we have different, funds which have different philosophies. Very clearly, in equity opportunities, the call is to have a balanced mix between the large cap and the mid caps. So I think while we have the flexibility of inching up a little bit more in terms of mid caps. We would rather have a balanced portfolio. But having said that, there is a flexibility of moving from 50 to 60% in mid caps, and right now the value definitely is there in mid caps.
Right now, are you 50-50 or are you
we are
60?
slightly skewed towards mid cap, so it would be 50 to 53% towards mid cap versus.
Okay, and you would think going up to 60 would be possible?
We can, the only challenge is in this kind of an environment, the impact cost to buy a mid cap is very, very high. So you have to also factor that in. So if I want to deploy 500 crores, it's not going to be very easy to deploy in a running away market to deploy 500 crores in mid caps.
Yeah, and the risk is high as well. By the way, we forgot to take a look at the rupee. There's been a huge move on the upside there as well. So almost 70 basis points higher on the rupee, moving in tandem, of course, with the equity market.
No, it's a little more than that. 59.80 was seen as a resistance level for the rupee. The dollar was believed to have a lot of strength there. If that gets broken, then perhaps we will start seeing a little more of sell calls on the dollar coming in. It's algorithmically placed that way. So actually the rise was very fast from 59.80 to 59.60.
Okay. Well, coming back to the markets then, Sunil, how are you, the stock that really takes one's breath away is Reliance Industries. Now 4% higher. I haven't seen this move in a very long time in one day for Reliance. But how are you positioned on oil and gas as a space? Would you, I see you don't have too much of it in your portfolio, but would you now go out there and buy?
I think our call has been that, overly regulated sectors are very difficult to take a call on because they move more on news flows rather than fundamentals. And I think that has been a major reason why we have preferred to be in other sectors. Having said that, we have increased our bets a little bit on the oil and gas, but we would definitely not have a significant overweight.
Okay. Well, a final question to you, Sunil. Who will buy next? I mean, FIs have put in so much money. Smart HNI is already in. Retail, as you say, is shy. Where is the next money going to come from?
You'll never know that, but money will come in. That is our call. And when you said that FIs have bought a lot, what is that lot? $5 billion?
Yes.
So, in a $50 trillion global industry, what is $5 billion? In fact, we have done a study. There is not enough stock available for FIs to buy. There's only $70-80 billion worth of stock which FIs can buy if they buy each and every stock which is available today at today's market price. And, if we again come to the trajectory of faster growth, there are not too many countries in the world which have the kind of improving fundamental potential which India has. So we're the only country where, there can be 13 rate cuts. There is no other country in the world which can even have one rate cut because they're already at the low as far as interest rates are concerned. So I think money can definitely come in. And even domestically, we have a saving of $400-500 billion every year.
So you don't see any global accident mid-year which could derail this whole process?
Because of the fear of accident, poor retail does not put money into the equity market. So we scare them with very exotic terms like fiscal cliff and QE tapering and now El Nino. And the poor retail guy just thinks that, the market is going to go down and just scare it. So I think a request to you, don't scare the retail investors.
And Ukraine, a country that no one has ever spoken about for so long. But anyway, thank you so much for joining us, Sunil. You have a good day.